Meet Zen, a trained mountaineer who spends most of his free time trekking. An ex-commerce graduate, Zen has always been intrigued by the stock market and has recently started trading and investing in stocks. But although his interest is high, Zen is quite clueless about how to assess market trends that would help him take timely decisions about whether to buy or sell a stock. Meet Zap, his college batchmate who trades and invests in the stock market. During one of his treks, Zen bumps into Zap.
Hey Zap, I'm so glad to meet you after all these years. I didn't know you actively traded and invested in the stock market. I've always been interested in making profitable stock market investments, but could never predict market conditions or analyze market trends for that matter.
Analyzing the stock market or stock price trends is an important step, as it can give you warning signs on when a trend is about to change or when the stock price is about to reverse.
Tell me, Zen, if you were to swim in a stream, which would be easier for you, swimming with the current or against it?
Swimming with the current, of course, as I would face less resistance, and this would make things easier for me.
Exactly. You see, analyzing market trends will also ensure that you move along with the trend and not against it, leading to making life a lot simpler for you by giving you higher profit margins. Actually, I can even teach you some trend analysis right now. It'll only take as long as this break that we're taking.
Sure, sounds good to me.
Let's start with the basics. What is trend analysis? Trend analysis is a method of analyzing the general direction of a market or the price of a security to potentially predict what will happen to it in the future. In the stock market, the price of a security fluctuates over time. When these price fluctuations are plotted on a graph, it would look just like the slopes of this mountain. See how it slants up and then trails down, or vice versa?
That's interesting.
Now, there are three types of trends: uptrend, sideways, and downtrend.
It's very important to understand that any of these trends can be short, medium, and long-term in nature. It can vary across the different time frames as well.
Let me explain how. If you were to look at a 2-year price chart, you could notice a long-term uptrend. However, if you go to a weekly chart within this 2-year time frame, it could be in a medium-term sideways trend. And furthermore, if you fine-tune further into a 60-minute chart, it could even show a short-term downtrend.
So we can analyze trends on different time frames as well, is it?
Yes, of course. An intraday trader typically uses the 15-minute or the hourly time frames. A swing trader mostly uses the daily or the weekly time frames, and the positional trader generally uses the monthly or quarterly time frames. You can compare them to the duration of the treks that we do. Some are small and last only for few hours, whereas some are really long and can go on for days and weeks together.
Okay, but how can you tell whether the market is in an uptrend, downtrend, or sideways trend?
Zen, you're familiar with the mountains, right? You like them?
Yes.
Well, just like mountains, trends have high points and low points as well. We use a concept known as pivot points as one of the most common ways of assessing the price action or the trend in the stock market.
Pivot points? Now what's that?
Prices don't move straight up or straight down. They move in a structure similar to a mountain range. Just like mountains have high and low points, similarly, even a stock price moves by making high and low points, which are called pivot points. An uptrend is formed when the price creates a higher high followed by a higher low. A line drawn in this case connecting two higher high pivot points would slope upwards and is commonly even known as a trend line. When a higher high is created on a price chart, it serves as a warning to traders as it signifies that the downtrend has weakened and one can anticipate a change in the trend to the upside. Look out for this warning. Once the higher low is also created on the price chart, it actually confirms an uptrend. In an uptrend, the trader should focus on buying securities or stocks and preferably avoid shorting. You should know that the steeper the slope of the trend line, the stronger is the uptrend.
Zap, I now understand higher highs and higher lows making an uptrend. What happens in a downtrend?
Aha, Zen, picking up fast, eh? A downtrend is when the price creates lower lows and lower highs. The trend line in this case would connect the lower low pivot points and would slope downwards, indicating a downtrend. When the market is in a clear downtrend, a trader takes advantage of the downtrend and focuses on selling opportunities. In a downtrend, one must avoid buying. Remember, the steeper is the downslope, the stronger is the trend.
Zap, what happens when the price creates equal highs and lows? It would look like a plateau, yes?
Excellent. This is called a sideways trend. When you join the two low points and draw a trend line, the slope would be flat, signaling a sideways trend. Here, a trader can ideally both buy at the lows and sell at the highs. Trend analysis thus helps a trader to predict future price movement and make buy or sell decisions.
Excellent. I'm totally getting this.
Now, there is one more element left to understand before you start using trends. It's called trend channel. Trend channels are often used by traders to make their trading decision as it indicates the range within which prices are likely to move in. It's formed by drawing two parallel lines joining the pivot highs and the pivot lows. Remember, however, that it is always better to use trend channels in conjunction with other technical tools. In an uptrend, when the prices are moving upward, the channel is created by drawing two parallel lines connecting the pivot higher highs and the pivot higher lows. The probability of prices staying in this channel is high. Once the price hits the upper channel, it signals a warning that the price will probably move back down towards the lower channel.
Understood.
This is also known as an ascending channel. Similarly, when a price creates lower highs and lower lows, the two lines drawn parallel to each other connecting the lower high pivots and the lower low points create a descending channel, as prices are moving in a downward direction. Again, the chances of prices staying in this range are high. Once the price hits the upper channel, it signals a warning that the price will move back down towards the lower channel.
And when the price is moving neither in an upward nor in a downward direction, but moving sideways, creating equal low and high pivots, then the lines drawn joining these pivots makes a horizontal channel. We can expect the price to be in this range.
Way to go, Zen! Your progress line is creating an uptrend.
Thank you, Zap. I'm now confident about analyzing market trends, and I'm willing to climb up the stock market mountain with all necessary equipment in hand.
To learn more about when to enter or exit a stock in order to maximize profits, tune into our BBRSI movie.